Okay, today's topic is all about irrecoverable debts. So we are going to learn about irrecoverable debts. Irrecoverable debts. Right? So today we will learn to define irrecoverable debts and to identify the double entry and then to show the impact. And the key vocabs that is related to today's topic: trade receivable, irrecoverable debt, debit, credit, expense, finally asset. Right. Moving further to the topic, let's find out the prior learning of this particular grid. You have a debit factor and you have a credit factor. Right. You have a debit balance, you had a debit balance and you debited it. Therefore, your debit balance would increase. You had a debit balance and you credited it. Therefore, your debit balance would decrease. You had a credit balance and you debited it. Therefore, your credit balance would decrease. You had a credit balance and you credited it. Therefore, your credit balance would increase. In today's lesson, we are focusing on two key areas. One is debit and a debit would increase, this one. And then debit and a credit would decrease. Right. Now let's take a simple example. When there is irrecoverable debt, you need to reduce your trade receivable. Let me number this number 1 and number 2. Trade receivables have a debit balance and you want to reduce it. Therefore, you will apply rule number 2. Next one, irrecoverable debt. Irrecoverable debt is an expense account. When there is an increase in irrecoverable debt, you increase it. And this applies debit and a debit to increase, which is rule number 1. The reason why we have to go through this, because it's very important to apply to today's topic. We'll assume your business has these 3 trade receivables. XYZ, all 3 of them are your trade receivables. X owes $5, Y owes $10, and Z owes $15. Therefore, your total trade receivable value would be $10, $25, $30. Suddenly, Y is not in a condition to pay you. When Y is not in a condition to pay you, what happens? This $10 becomes your irrecoverable debt. You're not going to recover this. Therefore, you need to reduce this 10 as irrecoverable debt and the remaining would be as same. Therefore, now your total value of your trade receivables becomes 20. Now, how are we going to show this impact in the accounting ledgers? Here, you reduce your trade receivables. Trade receivables have a debit balance. You want to reduce it, therefore you enter it on the credit side. You actually wanted to increase your irrecoverable debt. Irrecoverable debts have a debit balance. You want to increase it, therefore you debit it. Now let me open two ledgers. One ledger is for my trade receivable. I have total trade receivable at the beginning of the year 30. And irrecoverable debt, I do not have any opening balance. Therefore, I enter it as 0. Now, let's show the impact where there is $10 worth of irrecoverable debt. I'm applying this rule. I have to credit my trade receivable account. Go to the credit side of my trade receivable account, opposite account's name, irrecoverable debt, and I would enter 10. And then I would go to my irrecoverable debt account, enter it on the debit side under irrecoverable debt, 10 as trade receivable. Now, let me balance the ledger to show the impact. Debit side is greater, 30 take away 10 becomes 20, which is my balance carried down, balance brought down, 20. Now, we ended up getting the same answer over here as we finalized here. Now let's balance our irrecoverable debt. Debit side is greater, 10, 10, 10. Balance carried down and then balance brought down. Now how will this impact the financial statements? In your income statement, under the category of expense, you write it as irrecoverable debt, which occurred in the current year, which is worth 10. And in your statement of financial position, under current asset, you write the closing balance of your trade receivable, which is worth 20.